It started early on in my investment life when our family invested in a small mining company that produced many returns on the initial investment, and that materially changed our circumstances. So it had an immediate effect, and then when I came to being an analyst at an investment at a research house, I guess I was analysing a lot of big cap companies like Foster's and Tabcorp and Aristocrat, and I was just aware of just how detailed the questions were and how many analysts were in each meeting. And then I'd go to a small cap company and there weren't hardly any analysts, if any analysts, and sometimes I was the only analyst. So the information deficit was there, and I guess when people don't know about something, there's a lot more potential for, when the market does become aware, for there to be super returns to be made. Like most investors, we're looking for growth, and it's easy to screen for growth, and when it happens, it's hard to find growth stocks that are cheap. So we've had some success in the medical technology realm because these are sorts of companies that can be priced like a corner store but can have global potential, because what you're looking for is export potential, particularly from a small country like Australia. So we've had success with Certex, with medical developments, with Impedimed, and I guess we've had a few blow-ups, but our profits on the ones that have made it, that have gone through that, gotten over the hurdles and been able to export their product globally, has more than made up for the missed opportunities. Value, I guess, relates to discounts to earnings, discounts to assets, and the important thing about value is, unlike growth where you're paying a lot for the future, you're paying up for the potential of a company. In value, you're not paying anything for the future, so the future is almost an option. And this is where we find a lot of value, because in the small caps world, they've been mispriced by the market because they've basically been overlooked because they don't hit the fund manager levels. They can't get the kind of liquidity in these stocks to enable them to make a material return, and the stockbrokers, for the same reason, aren't interested in it. So that leaves a lot of stocks for us to look at. So we do screens of companies. So we look at the balance sheet, and we look at the cash flow, and we talk to management. Companies that we've tipped recently, such as Data3 and SMS Technology, they're in the IT services space. These companies experienced a lot of growth some time ago, but they've come off a lot now because IT services is moving away from a body shop where people are getting paid in terms of personnel, to one more of managed services where software as a solution is more predominant. So therefore, that includes the internet cloud. So they're transforming their businesses, and people are nervous about that transformation, and hence they're sort of avoiding these stocks, which is why we look at them. Well, small caps are always going to be fairly volatile, and so one way to mitigate that risk is to look closely at the balance sheet and to be aware of what their cash levels are, and what their debt levels are, and what their cash flow is like. Ultimately, your backstop as an investor is the balance sheet, and so we put a lot of analysis into that. But also, I guess, with a small cap, it's important to note that these companies are not diversified operations. Like, you take a company that we covered a long time ago called Red 5, which had a longwall collapse in I think the Philippines. That almost destroyed the company. Whereas BHP, they had a disaster in Brazil, and that is a disaster and it's a tragedy, but BHP will keep fighting. So there's a lot more diversification in bigger companies. So with small companies, you have to be very aware of diversifying your portfolio over time to, to match up with, the singular company risk that you have in a small cap, which isn't as diversified, has key management risk. And I guess when it comes down to it, it's a lot easier for a small company to fall over than a big company, and we saw that in the financial crisis. Against that risk, you've got the reward, okay? So the reward's a very important concept here, because big caps have been priced along the lines of the reducing interest rates. So as returns on income assets, on fixed income assets have reduced, a lot of money is being poured into big caps, thinking that they've got bond-like returns. But these companies have a lot of risk, and we're starting to see those premiums come out of those companies, because people are realising there's a lot more risk to a BHP or a NAB or a Commonwealth Bank than there is to a 10-year bond. In contrast, I guess for the small caps, because there's a lot more operating leverage, there's a lot more potential with return. So it's simply a risk return trade-off. And at the moment, we think small caps provide a lot more bang for your investment buck.